welcome. My name is Versie Church and I am a mortgage loan originator, which is a person that helps people get financing for their home loans or investment properties. So this video, we're going to talk about interest rates. All I'm hearing about right now is how interest rates are going up. I saw an article and it said mortgage rates hit 5% for the first time in a decade. I actually want to talk about what is an interest rate. So an interest rate is the rate that you are going to be charged by a lender for taking out a certain amount of money. So you want to buy a house, right? You're going to go to a lender to ask them to borrow the money, the rest of the money for the house. So because you're borrowing money from the lender, they're going to want a little bit of interest back on that money that they're going to be lending you. Your interest rate is the rate that your lender, your bank, is going to charge you for taking out that money. Rates increase when the stock market is strong, foreign markets are strong and stable, inflation is up. We are experiencing a high amount of inflation right now. Unemployment is low. The employment rate is going up. People are starting to get back to work. The economy is starting to thrive more, so rates are going up. So those are situations where rates will decrease and rates will increase, and it actually has proven to be true based off of the data that we're experiencing right now. Your rate does affect the amount of your house payment you're going to be paying. It's going to affect the amount of interest you're going to be paying. The thing about the interest rates is that they are out of our control. Your credit score determines your rate. Is not the only thing that determines your rate, but for the most part, your credit score, your FICO score is one of the main things that determines your rate. If we can't control the rate, we can definitely control our credit score. Let's say your credit score is at a 600. If your credit score is at a 600, you are probably not going to get the same rate that you would get if your score is at a 780. I'm going to be naming some things that are contributors into you having a good rate. Number one, your credit score. Your credit score definitely is going to affect your rate, because to the bank, they're going to see, okay, are you a responsible borrower? If your credit score is at a 580 and you have, delinquencies, you have missed payments, you have collections, then they still will lend to you, but they're going to see you as a little bit more of a risk. Your repayment history. So that goes into your credit score. Are you paying your bills on time? Are you getting a lot of missed payments? That is something that they look at as well. Your income and employment history, your level of existing debt, your cash reserves and assets. So the amount of money that you have in the bank and your assets will determine that. The size of your down payment, your property location, your loan type, your term and amount. So those types of things will definitely go into play in regards to your rate. And the reason being is because there is a charge to do certain things. So let's say, for example, you are going to be doing a refinance. There are different types of refinances you can do. You can do a cash out refinance and you can do a rate and term. We're going to just talk about those two refinances right now. So let's say you want to just lower your rate. That's going to be a rate and term refinance. And when you do a rate and term refinance, the cost to do that in regards to rate is going to be a little bit lower than it would be if you were to pull out cash. Now, if you are going the FHA route, which I call the first time home buyers route, versus if you're going to be getting a conventional loan, then sometimes the conventional loan rates are higher.